CF Benchmarks.
What you're about to hear is a recording of a CF Benchmarks X Space captured live.
Everything on this show is for informational and educational purposes only. It is not investment advice, and nothing we discuss is a recommendation to buy, sell, or hold any asset. The views are our own and do not represent CF Benchmarks, Kraken, or any affiliated firm. Any price targets, valuations, or models we mention are illustrative and not forecasts. The participants and their firms may hold positions in the assets discussed. Digital assets are volatile and you can lose your entire investment. And some products we reference may not be available in your region. Always do your own research and consult a qualified financial advisor before making any decision.
Morning, everyone. Welcome back to another CFB Talks Digital Assets Live. My name is Gabe Selby. I'm the head of research at CF Benchmarks. With me, we got the regulars, Mark Pilipczuk, our research analyst, Tomas Perfumo, Kraken's chief economist, Peter Stern, our head of sales at CF Benchmarks. Our guest this week, we have Christian Isaac, who is our colleague here and does a lot of quantitative research and works on the product team, and Val Gui from xStocks. So we're really excited to have this lineup here for you all this week. It's going to be, I think we're going to be jumping around a lot of different parts of the markets, a lot of different parts of the industry, and talking about what's going on. Just to kick things off, two things this morning. We just got the June payrolls report. It came in a little bit softer than expected at 57,000 against 157,000 consensus. So that's a clear miss. We're seeing the market react as what we would expect it to. We see Fed hikes starting to be priced out as we speak. Nothing too material, but I think odds are kind of falling across the board precipitously with that kind of softer jobs number that's giving us more of like a dovish bias with that reaction function. 2-year yields down about 5 basis points to around 4.1%, and the 10 years holding steady a little bit around 4.5. Also we should probably mention, since we got Christian on our call, who's from Spain, the U.S. men's are looking pretty good. We just beat Bosnia. I think that's the first knockout win for the U.S. team in 24 years. So congrats to them. Christian, do you think we're going to be facing you all in the next, maybe in the 8th round or the final 8 round?
Well, I certainly hope so. I have to say I'm not especially happy with Spain's performance. I mean, admittedly, they always have a slow start. So I'm hoping that they, as usual, they pick up. Definitely the Cabo Verde, match was not great performance. So let's see today. I'm actually heading with my wife to a Spanish bar / restaurant to watch the game against Austria, right? I actually have to check. I haven't even checked, which is funny because I used to live in Austria, so a bit of mixed feelings there, but definitely going with Spain naturally. So hope to see you guys further up.
Yeah, Val, curious on which teams are you following the U.S. team very closely as well?
I have been, yeah. Yesterday's games were all actually pretty incredible, and then of course the U.S. Man down with that second goal was a lot of fun to watch. It's been an incredible World Cup, I think, so far from an excitement standpoint.
Yeah, as a casual spectator who's not, I would admit, not the most, I don't watch it too closely. I have also been pretty entertained, so I think that says a lot of what's going on. And Val, yeah, I want to also just give you maybe a quick second, since you're our guest of honor this week, just to give you a quick background on yourself and what you do at xStocks, and then later on in the show I want to give you a proper segment here where we'll go into some of the stuff that you're working on with xStocks.
Yeah, absolutely. So broadly, I run equities for Payward and Kraken, both our traditional broker-dealer and then our tokenized equities efforts. Within tokenized equities, the big sort of project that I am working on and supporting is xStocks, which are these permissionless digital representations of underlying equity. So when you think of an xStock, it's a one-to-one token that you can trade permissionally, self-custody, take on chain, trade 24/7 in secondary markets that is backed, like I said, one-to-one by the underlying equity. So it's a very global product. So we have that. And then we have a third part, which are tokenized equities, but they're permission tokenized equities, like the partnerships we have with organizations like NASDAQ, where we're helping them build out their direct tokenization infrastructure. So quite a broad scope, and tokenization is, it's definitely been the hotness over the last year or so, and seems to be continuing that way.
Yeah, the trend in tokenization and the momentum there is really interesting just because of how we've seen it diverge so much with the markets. And certainly, I think we're going to go into a lot more details later on. I think it'd be really great to kind of open the show and to give some color on, what just happened in the month of June. And to Val's point, you've got that momentum in the equity markets. The S&P 500 just booked its best quarter since 2020. Meanwhile, if you look at our indices across the board, most of them fell double digits in June. Digital culture was the worst performer, near 21%. Mark, do you want to give us a quick rundown? We just dropped our latest monthly market recap, and it had some good tidbits in there. So I recommend everybody checking it out yourself if you're listening. But Mark, why don't you just give us a high-level overview?
Yeah, so overall, June was a pretty rough month for performance. Just take a look at the broad market, our broad cap index, down about 18.6% and down about 35 on the year. So really across the board, all sectors of the market we track are really down in the 30-40% range on the year. The only standout was DeFi, and it didn't draw down as much, only down close to 10% last month. And that was on some news on Uniswap and Aave, some fundamental developments on the fee side, as well as some bullish price targets coming out of some banks for those. But yeah, really every sector of the market. A kind of better way to look at this under the hood when you have just these broad drawdowns is through our factor portfolios. So we have long short factor portfolios, momentum, value, growth, liquidity, size, downside beta, that you can check out on our website if you want more info, and Christian can dive more into this too. But really through Q2, the only factors that held up well, factor portfolios, were value, growth, and size within that factor range of factor portfolios. And the one that's interesting to me was the size factor. So what that does is that's long the smaller cap tokens and short some of the larger cap tokens. And what we're really seeing in there is a lot of that outperformance was on the short side. It's these large cap tokens like Bitcoin Cash and ADA that are really starting to underperform the market. So think about like some of the larger tokens that have maybe high valuations, but no real users or activity on those chains. So we're starting to see the market move capital away from there and towards some of the larger cap or large cap tokens like Bitcoin. And on the small cap side, on the long side, we actually just didn't see them draw down as much, mostly because they dropped so much in 2025. There was no real altcoin rally this market cycle.
One thing that's really sticking out to me is this dispersion. You've got these higher beta names that you can find in like the culture category or the layer 2 names that are falling, I would say, at a factor of 2 times more than what you're seeing with some of these DeFi names that have a real revenue story, right? Christian, I want to bring you in because you are kind of the godfather of crypto factors and created the factor model here at CF Benchmarks. How do you look at that dispersion between some of the fundamental names that have actual revenues tied to the network and supporting their tokens versus ones that don't?
Yeah. So first of all, I wouldn't necessarily call myself godfather, although I appreciate the compliment, Gabe. But I mean, I think it looks back to what we're currently seeing with size. I think it's, to Mark's point, it's very, very interesting what's happening with size. And the broader way of looking at it is that this may primarily reflecting the factors sustained underperformance over the past year, suggesting that smaller cap assets had already undergone a significant valuation adjustment prior to the quarter, and therefore proved relatively more resilient during the subsequent sell-off. But to your point, so we see size, and we've seen also value outperform. And value is the relationship between the two of them is very interesting because there's typically, even in TradFi, we observe somewhat of a positive correlation between the two, and that is because there's a higher likelihood of smaller assets to be undervalued, and therefore you see them many times co-moving together. So I think that you're just naturally seeing that rotation away from what has been usually perceived as assets that are more robust to downside, such as larger cap and liquid assets. And now investors are really starting to think, okay, well, let's just start to really look into what is the differentiation based on fundamentals, which of these assets are really showing good fundamentals. May that be on the value front in terms of revenue and fee generation relative to their market cap or TVL, and also looking at growth. Which of these assets seem to have and are likely to have a bright future in terms of growth. So I think that this was a long time coming. It took some time to materialize, and I think the trend will be this moving forward.
Yeah, I think it's really interesting. If you look at some names in the DeFi space, you got Aave, who let's just say does an annualized protocol revenue run rate around 330 to 360 million. And if you look at the market cap to revenue, it's pricing it not quite at single digits, but it's definitely getting lower double digits, so around like 13. And that's something that's kind of interesting to see, that there's this like fundamental value story that's being created with this pullback with these names that have real revenues tied to them. I wanted to kind of go into the history books and talk a little bit more about this equity crypto divergence, because in the summer of 2021, Bitcoin fell by half on China banning miners, basically. Well, equities continued to rise, so that was more of like a crypto specific shock. And in 2022, we of course went into that rate hiking cycle where both equities and crypto were falling. I want to pass this over to Tomas and Val and get your guys' perspective on this divergence between these two asset classes. Are we more like 2021, or are we in something more like 2022? Because if you look at the headlines, we're still talking a lot about macro. We're still talking a lot about the Fed. We're still talking about sticky inflation. It's kind of tricky to kind of understand why we have this idiosyncratic performance in a very macro dominating headline environment, I would say.
I can maybe take sort of a first crack at this, although I think Tomas is definitely probably the probably the expert here. I think that the macro has been a piece of it, but I think that at least on the equity side, where I'm sort of more qualified to think about what we've seen with xStocks and on the tokenization front, because of the permissionless nature of it. Globally, at least in the last year, really since we've launched, there's a couple other companies that are doing similar things. The access to equities has just increased dramatically within the native crypto ecosystem. And so, especially with the current, I don't know if I call it hype cycle, but let's call it the super trend around AI. It's definitely pulled liquidity from more traditional crypto native type assets into crypto assets that behave more like equities, like xStocks. And that has impacted the sort of equities markets. And I think that we're going to continue seeing the sort of blending or less of a divergence between sort of native crypto assets and native sort of traditional finance assets, because they're actually just going to become one and the same over some relatively short period of time, and that's just evidenced by the idea that like even the TradFi players like Nasdaq and New York Stock Exchange are all coming on chain in some way, and so I think it's the sort of the natural evolution as these two worlds converge.
Yeah, that's exactly kind of where I'm seeing that same read on it as well. Tomas, I think you've got speaker privileges again. I'm not sure if you want to jump in and see if they're working.
while we get him back on, I think that this
Oh,
was
here we go.
sort of the sort of thought that I had sort of going into and when we launched xStocks about a year ago. But I think, I come from a more traditional finance background. Used to go to conferences called Money 2020, which are very TradFi conferences. I went to Amsterdam this year, earlier this month, and was shocked at how much that very traditional TradFi conference had become at least 50-50 TradFi versus DeFi or sort of crypto. And it was just the biggest change I've ever seen. And I've been going to that conference for a decade at this point. And so I think you just see that convergence.
It's really true across the board. I mean, this year particularly, all the crypto conferences, comparing those, to last year, 2 or 3 years ago, it's just night and day with that participation that you're getting from the traditional players coming in. They're all hosting panels now, and seem to be very enthusiastic about the space. Um, Thomas, I don't know if you have the speaking ability here, but let's give it a shot.
I think I do now. Yeah, sorry about that.
Well, fantastic. Well, yeah, I was curious on your views of what's going on with this divergence in equities and crypto. I gave a little bit of a historical breakdown of what we saw back in 2021, 2022.
Yeah.
Certainly, what Val was saying, I think, makes a lot of sense with AI and access to equities just growing, being really dominant forces, really creating this divergence tailwind for equities. Well, what's your take?
I mean, from my perspective, the bridge between, the environment we were in last time and this time and how it's playing out differently just speaks to like the maturation of the asset class because I joke around about this a little bit, but like since the ETFs launched, MicroStrategy and the ETFs have collectively bought more Bitcoin than the entire market cap of Bitcoin was 6 years ago. And so, like even back in 2022, where you were referring to the last rate hike cycle, Bitcoin was a much smaller asset class, and the crypto industry was much smaller in general as well. I know we went through a boom bust at that period, but nevertheless, it was still kind of niche in that sense. And so it had its own kind of idiosyncratic flavor where it could really outperform in a short period of time, despite the kind of overall macro cycle. And this is the first cycle that we are living through where Bitcoin is not only a lot larger in terms of market capitalization, but the interconnectedness of it all. And Val being here is like such a good example of this because we're seeing so much growth in tokenized equities and it's just increasingly converging. This like TradFi crypto clash, if you will. And it's increasingly looking like it's just going to be like one big story altogether. And it's going to be like completely integrated, smoothed over, et cetera. And the reality is for assets like Bitcoin, you're just going to increasingly feel the broader macro environment as part of just like the day-to-day valuation liquidity story. Whereas, even 4 years ago, it was its own little insulated kind of bubble that didn't need to necessarily react as much day to day with what was going on in TradFi. I think that story's dead, unfortunately.
I want to pass this over to Peter because he sits very closely between the bridge of the TradFi audience and also the native crypto folks and get his read on this divergence. And yeah, I want to just get your opinion, Peter.
Yeah, I mean, I would say it's been to just like on the, and I'll chime in on the tokenized part as well, that a lot of the institutions that we work with, and we were fortunate enough to help a lot of the asset managers out there get the Bitcoin products, the ETFs launched. Obviously there was the big hype on that as well as Ethereum. And tokenization has been in the market for a while and been the top of mind to most institutions, but more recently we've seen really a lot of them are very interested in the xStocks platform or getting their current ETFs or other products tokenized. And a handful, and I've been on a couple calls with Val where we've spoken to institutions particularly that, we had actually spoken to in the past about digital assets and, getting more of a spot product launch, but actually being able to, seems like a lot of them are taking this as an opportunity to dip their toes into the, digital assets market by tokenizing current products. And, I went to even the Solana Policy Summit, I think it was 2 weeks or so ago in Chicago, and that was really one of the main points of conversation. It was heavy regulators. There was a lot of lawyers there as well, but tokenization and kind of, the large institutions that were sitting on the sidelines, I think finally have the ability to enter the market using tokenization to give others access to their products. And I think it's as well pretty interesting from like a Kraken perspective. And Payword was, you have a lot of people that are using the exchange that are very crypto native that have a lot of concentration in, spot digital assets, but now have a way to diversify away from that. Still use the same platform under one umbrella and get access to these equities and ETFs, but in a tokenized wrapper, which for them is just significantly more efficient.
In June, according to our report, we highlighted how $4.1 billion left the ETP ecosystem here across the globe. Of course, most of that is concentrated in Bitcoin with minus 4 billion, and particularly in the region, the US, which is the dominant capital market in crypto ETPs. But we're seeing basket and index funds still taking in some inflows, and we're also seeing hyperliquid ETFs holding up their demand. So we're seeing that rotation in appetite and capital repositioning rather than completely leaving in some ways. Is this kind of like a point where we're seeing like the next bid start to form with these types of products, Peter? Is that what you're also seeing?
Yeah, I mean, I would say that, a lot of you and I have a certain opinion, obviously, that, the multi-asset products, I think are a great opportunity just because they're, a one-stop shop to give you exposure to, 95% plus, of the digital assets market. It gives you access to everything you need. But I think, again, it stems back to coming from the TradFi world. A lot of, the advisory market is, a lot of them did dial up their positions in Bitcoin and have kind of trimmed those positions. But, some of the more sophisticated ones are moving over toward other assets. They're not, as you said, leaving the digital asset space. They're just diversifying their risk and potentially going toward other assets. But I also think too, again, with the tokenized equities piece, that we're still seeing a lot of people get into that market, and people aren't exiting digital assets as a whole. They're just, educating themselves and, diversifying and going into different types of vehicles. But, the multi-asset, I don't think really has taken off yet, just because there still is quite a large education learning curve from that standpoint. The advisory market, I don't have an exact dollar amount, but between RIAs, independents, broker dealers is, in the hundreds of trillions. And, that it's really still a lot of them are being educated or didn't have access to buy anything at all. So, my kind of prediction is, potentially in the fall or maybe Q4, we'll start to see inflows again, particularly because these brokerage firms actually have access to buy the funds now.
Guys, that's really great stuff. Is there anything else that anybody wants to add kind of on this segment before we jump over to MicroStrategy? Because there's definitely a lot that we need to cover there.
Maybe just very quickly on the tokenized equities piece. I think it is very exciting. I'm particularly very excited about, at least. And I think that there's a specific area where it's really providing a real service to financial markets, and that is extending price discovery into periods when traditional equity markets are either closed, particularly overnight. You still get some spot markets, you still have an aftermarket, a pre-market, and overnight, but obviously liquidity is very thin. So adding to that liquidity can help with, with price discovery. But most importantly, I think over the weekend, right? Because during that period, there's literally a blackout. So, if a major macro event or a company-specific announcement happens outside market hours, investors currently have a very limited ways to react or manage their exposure. So I think tokenized equities help fill that gap, especially as liquidity starts to build up. And so it's just another instrument to provide this pricing and hedging opportunities. and risk transfer. So I think it's a very important piece, and probably will work very well with equity perpetuals that also help with that price discovery. And I think it's something to keep an eye on.
Yeah, that you're kind of setting us up for the topic that we wanted to go over later. So I think maybe we just jump right into it. We've got Val here.
Yeah.
Let's start jumping into xStocks, and then we can kind of jump back over to what's going on in other parts of the industry with MicroStrategy. And so, Val, I mean, Christian's bringing up a great point that whole 24/7 access when New York closes on 5 p.m. Eastern on a typical Friday. In this case, we're going to be closing, I think, on Thursday because of the holiday. What happens to price over the weekend? How do we measure the prices? In a 24/7 market.
Yeah, I love this. I love this topic because this is an area where, and I promise we're going to publish some of this data soon. We're actually working with some of this data because we pulled it in conversations with partners that are looking to understand what should weekend pricing be, and how can we think about indicative pricing for the weekend? And as we start to form that and start pulling the data, you start to see like real price discovery, especially on the assets on tokenized equities, xStocks specifically, where we have the deepest liquidity. Not every name is very highly traded, and so we're still building liquidity some places. But for call it the top 15, 20 assets, there is deep liquidity. There is very vibrant trading on the secondary markets, and you can see that while spreads may expand a little bit on the weekend because there's not as much confidence in the pricing, they're not expanded significantly, and you do end up getting this really beautiful price curve from end of trading on Friday to the open on the following Monday, or even over holidays, that you can see the price really react both to news that might come out on the weekend. And this last year has been a very interesting year because lots of news has come out on the weekends. And so you can see the market react to that in real time on the tokenized equities front. And then you can see as we get closer to open on Monday, the prices converge. And so, you see real price discovery that's actually happening on chain, which is, at least from a traditional equity standpoint, extremely, extremely interesting. And I can't say too much, but we're talking to some very significant brand name institutional players that want to start using that pricing for their own internal purposes, from a market hedging, understanding opening and closings, weekend trading sort of standpoint, because we're really starting to see that. That to me is maybe one of the most exciting things that we have started to see now that there's sort of real liquidity in these markets, and how price is moving.
I think, yeah, I think that's that thing that you're referring to, that weekend gap dynamic that we've all been used to in markets for so long, where the futures close and then you get the Asia open on Sunday, and that's usually when you get your push notifications if you've got your CNBC or Bloomberg apps on your phone, and you see when the market's going to reopen. You have that big gap. It's going to be really interesting to see how this is going to evolve, because it's happening right now in real time. We're in the moment where this is evolving to kind of basically, like you're saying, that price curve close that gap or give you the lead on the gap on where these the futures market's going to open each weekend. And so we've got a long weekend ahead of us. As we know, we got the 4th of July celebrations, and I think just like last weekend, we found a lot of uncertainty with geopolitics. Seems to happen every weekend. So
Yep.
this is going to be kind of on my radar for this weekend as well. Christian's actually someone who I want to get in here to talk a little bit about pricing these types of assets. He works very closely on the product team here, or he's on the product team, but he works very closely on these types of projects. Christian, why don't you give us a quick rundown of how CFB handles these tokenized projects?
Yeah, so I think it's not an easy task. I think that a particularly exciting area of research is understanding how tokenized equities work alongside equity perpetuals as well, because you have the same issue over the weekend. You don't really know what the underlying spot price for these perpetuals are, and then you got the Monday effect. And if there's a huge development, I mean, you can get liquidated very easily. That can also translate to traditional term futures as well. And so I think that having this tokenized equities trading over the weekend, they can really show you what the underlying spot price is, and to manage it accordingly. And again, I think that here it coming back to equity perpetuals over the weekend, tokenized prices could be one of those instruments that you could use in order to to use as the underlying spot prices. I mean, you can also look at term futures and try to reverse engineer from the term futures the spot prices, perhaps a relatively direct relationship between the two. But then again, you run into the same issue over the weekend, that it doesn't. There's a significant gap there. So tokenized equities can come in very, very handy for that. And the last thing that I want to say is I think that it will also be interesting to see how tokenized equities interact with their traditional finance counterparts. So namely listed equities, term futures, and the indices they belong to. So in traditional markets, we often observe some lead lag relationships between futures and their underlying spot markets, or even the indices that they belong to. I mean, of course, we're talking about milliseconds lead lag relationships, but still, nonetheless, these are things that very sophisticated traders and institutions exploit. And so it'll be fascinating to see whether we see similar dynamics emerge between tokenized equities with their equity perpetuals counterparts sort of representing the on-chain piece, and then seeing how they interact with traditional markets as liquidity continues to deepen.
Val, could you give us a quick rundown on xStocks' offering and how that can compare with some of the competitors in the space, and kind of what makes it so unique?
Yeah, absolutely. I mean, so I'll start with sort of high level of what we're trying to achieve at xStocks, and I think the first one is access. We started when we launched a year ago with access to U.S. equities. We have international equities coming around the corner. Look for an announcement later this month, actually, and a launch later this month as well. So we're very excited about that. But at its core, xStocks is just it's a very, very simple product. It is the token, which is a digital representation of an underlying equity, and that underlying equity is backed and pledged directly to that token. And most importantly, it's permissionless. So when you think about xStocks and xStocks as a platform, I sort of try and categorize it as the sort of AWS equivalent for Payword, as the way AWS is to Amazon, xStocks is to Payword, and by that I mean we're a platform and we're a neutral platform. So yes, xStocks are available on Kraken and it's a wholly owned subsidiary of Kraken, but we built it in such a way where we want to have other partners that are able to use and offer xStocks so that they can give their own end clients access to these equities and these tokens and build on top of it. And that's why we have so many partners like centralized exchanges like Bybit, within decentralized exchanges, intent networks, wallets, et cetera, et cetera. And so that I think is probably one of the most unique aspects of it. You look at like what was just launched recently, Binance, Coinbase, Robinhood, all just announced really similar products. Those are great for end consumers from an access standpoint. Like we want access, as much access as possible. The challenge is that those are tied to ecosystems that are just more closed, and they're purpose-built products that are meant to benefit the parent organization. Whereas we're really trying to build a platform that others can build on top of. And so far, we've seen have done a really great job of that.
So yeah, thanks for jumping into some of those markets and the partners that you're all working with there. One thing that I find interesting is the fact that with the RWA movement, we saw treasuries and kind of cash equivalents be tokenized first, which of course are counter-cyclical type instruments. And then if you're looking at what's happening now with tokenized equities growing so fast over the past 12 months, that's more of a pro-cyclical kind of risk-on type offering. Could you give us a little bit of a preview, if you're comfortable sharing, on the roadmap of xStocks and kind of what other asset classes are we thinking about offering? Is there like a cheat sheet and kind of how this goes? I think there's a lot of opportunities, I think, to democratize some of these other less liquid or tougher to get type instruments and make them permissionless and put them on chain, right? I think Val, do
Types
we
of
still have you
commodities.
here?
I won't say specifically what we're doing or how exactly we're doing it,
Val, you have
but to your
to
point,
start over.
we do want to have some products that are
I think we lost you there for a second, Val.
not as tied to being pro-cyclical the way that that equities are. We've been heavily boosted by the fact that equities markets are hitting all-time highs, and there's a lot of fervor around getting into very specific names. You look at, maybe the top 15 or 20 names have the most have 85% of the trading volume, despite us having hundreds of X stocks available. So that's great and interesting and good for people that want access to that. But we know that at some point, people might start looking to diversify. And so, to your point, being able to provide other products is sort of going to be important as well. And so, we are launching new products, things like commodities, and then other exchanges as well, to give people an opportunity to diversify from a geographic standpoint. Is also going to be big and important also. So both of those are happening. We've looked at other asset classes also, things like real estate, things like private market investments. I think that the challenge there is always is with both how do you provide liquidity, and then how do you also help support price discovery, right? We're seeing organic price discovery on X stocks because there's so much volume and trading volume that can happen organically. For these other products that already are liquidity constrained, how do you bootstrap enough liquidity to get to a point where there can be that sort of organic price discovery? That is the ultimate challenge of providing other tokenized assets or to these other products that have inherent liquidity challenges for the underlying. Working through those, I can't say anything specific around what and a way we might launch, because those are still a little bit farther out. But those are sort of the big considerations we have.
Do you find those same issues with these pre-IPO shares? Because that's something that's been very popular, I think, and it's gotten a lot of people excited, especially when we've been in this big kind of IPO season that we just saw with the SpaceX launch, and you all participated with that as well. I don't know if you could go into kind of like the challenges that you ran into with those projects. I think, Val,
I
I
think
think you might be.
yeah, we may he might be off, but I can chime in on this very quickly, Gabe, if you
Yeah,
don't mind.
thanks.
I mean, I'm equally excited, as you mentioned, on pre-IPO tokenized equities. So here at CFD, we've been working on figuring out how can one, measure the underlying spots, and how can one get a real-time spot price for these private equities. And I mean, first of all, I think that giving investors access to companies such as OpenAI, Anthropic, SpaceX, and so on before they go public has huge potential to democratize an asset class that has historically been reserved for institutional and venture investors. But from a market structure perspective, pre-IPO perpetuals are also a fascinating innovation. So one of the key challenges is estimating the underlying fair value, as I mentioned. But I think there's a couple of sources. So there's already private secondary markets like NASDAQ that provides executed trades, and also daily estimates of the fair value of the company. But the limitation is these values are daily, and again, they do not print anything over the weekend. And so, with continuous price discovery from the crypto native perpetual markets, this can provide a robust real-time estimate of fair value. So now we're still working on figuring out how that can be integrated together. I don't want to get into details. There's different statistic techniques you can get into Kalman filters and so on and so forth. But more broadly, I see this as another example of crypto introducing genuinely new financial infrastructure alongside xStocks. So perpetual futures themselves, I think that they never gained widespread adoption in traditional finance, yet they've become one of the most successful innovations. I think the same is going to happen with, and is already happening with xStocks. So excited to see how these two are going to work out together. Hopefully we can get to see xStocks to bring some of these things in chain as well in the form of actual underlying equities.
Yeah, sorry, I cut out a little bit. I sort of caught the tail end of that. That is one of the exciting things that we're seeing is both ourselves and our partners are building perps on top of xStocks. And so that is an additional way to expand sort of the product set, which is an exciting aspect that we're seeing.
Yeah. One thing I would add just really quickly, because I think people gloss over it a lot, but the pre-IPO markets are like really fascinating because a lot of people I think confuse the spot products versus the like perp or derivative products, and there's so much nuance in the construction of it. Like I'll give you just an example. If you were allocated shares in the SpaceX IPO at their IPO price of 135, you would have made money, right? But if you bought SpaceX anytime, in the month before they IPO'd via perps on Hyperliquid, you would have actually lost money. And the reality is that the two were really referencing two different things, right? The spot product was I'm getting exposure to the value of the company as it is before it enters the secondary market live, whereas the Hyperliquid and the perp market is trying to reference where will this thing cross when secondary markets start trading. And so I think a lot of people have brought the two or made comparisons between the two, but the truth is like it's an interesting catch-22 where the perps market struggles around trying to put together a clean reference rate where you can create like a leveraged market around it. And the spot product struggles around how do I get exposure to this asset that in many cases may have like restricted trading underneath it. Like it's not trivial, for example, for someone to get their hands on Anthropic shares, even in the secondary market. And that's why you see so much of this growth in like SPVs and SPV squared and cubed and whatnot. So there's just a tremendous amount of demand, but the problems are still pretty interesting, and I think we'll probably end up finding a good solution across a lot of experimentation in the market.
I know. So it's kind of maybe fair to say that with the perps markets on these pre-IPO names, it kind of tries to create like an indicative pricing of the actual like public market listing of the private company. And when you're in the spot markets, you have the people that are actually transacting with the company itself, getting the shares, and two, you have the spot markets that are also kind of like a secondary market of, on top of that, right? And that's going to give you premium and discount mechanics as well, depending on what you're saying, the restrictions, the demand, appetite, and what have you. So I guess we're creating just a lot of different venues. What do you guys think of the recent talks on creating like a different regulatory framework for these types of IPO names? We follow the framework of accredited investor rules, and I think there's been talks about getting rid of that. I'd be curious, since you guys, Val, why don't you go first? Give us your opinion on that front as well from the regulatory side.
You're really trying to get me in trouble with our legal and regulatory team.
That's why we brought you. That's why we brought you on here.
Uh,
So,
I know, I know, I know. Listen, I have my opinion, and I have the opinion that I'm allowed to share. No, I'm kidding. I'm kidding. I'm kidding. No, I mean, I think that I tend to be all about access. I think you should give people the opportunity to participate the way they want to participate. Um, I do think that there are different levels of sophistication, and there is some value in making sure that those that maybe haven't participated in a type of market yet do have some sort of maybe call it slight protection or some ability to make sure that they're not just fully taken advantage of. That is it's challenging to do, right? Because regulation can sometimes be heavy-handed or not nuanced, and it it's challenging to apply regulation in a way where it can be applied in sort of individual cases, right? By sort of default, regulation tends to be just um, uh, extremely broad, and doesn't look at individual cases, and it's sort of meant for quote unquote the masses. And so do I think that there should be some sort of regulation and framework? Yes. Do I know what that should actually look like? I have my own personal opinions, but I don't think that's necessarily the way that the market is going. Um, uh, but I do think that first and foremost, we should start with, and regulators should start with the idea of how do we give people more access, not less access. I know that was sort of very high level. I didn't get into the details. I'm trying not to get a yelling from our reg team.
no, we don't want
I
that.
mean, for what it's worth, like I followed this accreditation standard like quite closely over time, and it there is a mandate already to review it and to modify it. I mean, the best example of this, and a lot of these rules haven't changed in probably decades. They're not even inflation indexed to my knowledge. But for example, a few
No,
years
they're
ago,
not. Yeah.
they made it possible for accreditation to include people who have passed and have a series license. Now, the problem is that that's not super democratized because if you think about how do you get your series license? Well, you have to sit in for the series exam, but to take a series exam, you have to be sponsored by a FINRA firm. So as an individual investor, unless you work at a investment bank or a broker dealer, you're really not able to even participate in there. And so yeah, we've seen discussions in lobbying around programs, certification programs like being a CFA charter holder, for example, but none of those have been adopted yet. So I feel like it's been a long time discussion that hasn't been top of mind for a while in terms of the regulatory agenda, but it has been changing very slowly over years. And I think players like Robinhood, Vlad certainly has been a big proponent calling this out and trying to score wins whenever possible. So I do think it'll change eventually, and if not for the fact that the reality is in the data that there's fewer IPOs, there's fewer public companies, and when they do come out public, the valuations are much larger. And naturally, um, you may get to a point where it's like the performance post IPO is so negative that people are forced to confront, hey, like maybe it'd be better if we create an environment where investors and companies feel comfortable coming out into the public market earlier than they have been. Like, what can we do to change that? And this might be one step, I think.
Yeah, I was just going to say, I'm also like a big fan of the idea of more people getting access to some of these products. I've heard people float the idea of there being tests to see if you're sophisticated enough to get into these. But yeah, because one issue this does cause is you start opening up the possibility of a lot of lawsuits to start flying when you open up anyone can invest in these private companies. Because when you look at the data, a lot of these companies, especially at the earlier stages, tend to go under. So you have to kind of balance out how many people do you want to essentially go in, lose money, and then start backlogging the courts with all these lawsuits against all these private companies.
Yeah, I think one thing that I would bring up is just kind of think about what's happened in the past few decades with IPO, um, the IPO decision tree. If you are a company and you're having so much success being a private company, when do you want to list on a public exchange? We've seen the supply, the actual number of companies going public, just continuously go down over the years, right? And so if you were to fundamentally restructure giving access to a broader audience, to pre-IPO shares, to private companies, creating a new accredited investor framework, it would reshape, I think, a lot of that dynamic that we're seeing. And I think the IPO process would be kind of less about capital raising event and more about liquidity and market structure that you'd see. And it would actually, I think, ultimately, um, I think, create less of a hesitation for companies to go public, because you'd be able to kind of have that broader access in the private markets initially. And so the step change from going private to public is a little bit less, right? Or it would be dramatically less, in my opinion. So that's something that is something that I think would be beneficial overall for society, as we've seen
Yeah.
kind of that dynamic happen.
Another thing too is we see a lot of companies not even go public. We'll just see them get acquired by a larger tech company too, and those gains are completely missed out on by the public because
That's a
nobody
good point.
has access to that. So we're not even counting that number of companies here.
Well, team, I think we're running up against time. I wanted to talk a little bit about MicroStrategy, but given the news, and we only have about 8 minutes or so, and then we also want to give the week ahead rundown. So maybe we'll have to be really quick with that. Uh, I know, Tomas, you've been following the story very closely with the recent capital plan. Is this plan given Michael Saylor, the ability to just become a Bitcoin seller? Is he picking the preferred dividend protection over Bitcoin? What's your take on this overall?
I have a couple takeaways. One, I think the decision to load up on the capital and quote unquote cure the overhang, was probably a month late, but like, better late than never. And what he's done is he's basically turned it from hey, there's 7 months of dividend payment runway to 18 months. And candidly speaking, putting my public investor hat on, like my old job, it's really hard to short a company or to come up with a bear thesis um, that has that kind of runway, even though it doesn't sound like, 5, 10 years. A year and a half of being short a commodity with the convexity of Bitcoin is like very difficult. Um, and so I think we've already seen a recovery in the NAV premium. It traded down as low as like 1x. Now it's closer to 1.15, 1.2 as of today. So that's encouraging to see. The other takeaway that I think is really relevant is Bitcoin like barely moved on the news. And for the past 2, 3 weeks, I've heard nothing but, hey, if Michael Saylor like builds the balance sheet and just does that big dump of Bitcoin, then Bitcoin can finally rally again. The overhang's cured. And that didn't happen. And I think it points to, what we've talked about in past episodes here, which is that I personally just don't think MicroStrategy is the problem. And I think the fact that he's bought over a year and a half of liquidity means that, and the market doesn't react to it, just showcases that, validates it. I think it's a Bitcoin ETF problem, capital rotation outside of crypto, and so for me, that was kind of the main takeaway from the news this week.
I think he's walking with a big stick now. I think that worked with the price action on the stretch shares. It seems to have stopped the bleeding. And look, if you're someone who believes that the market's going to recover in the next 3 to 6 months, such as where we sit right now, that type of window that he set up with his dividend runway is going to be enough to where you won't have to use that stick. You'll be able to kind of to mitigate further bleeding out of the stretch preferred in the market pricing. So yeah, I think it was kind of it's definitely something that I didn't predict that they would do, but it so far seems to be working, and Bitcoin price didn't react like you said. So
Yeah, the way you're phrasing it is exactly right in my opinion. Like he put it in a position where the thesis is pretty squarely, are you long or are you short Bitcoin in the short run? That's kind of what it turned into.
yep,
There's no more like mechanical, oh, forced unwind story. It's just, are you long or short Bitcoin in the short run?
love it.
Yeah, what I kind of wonder though for the common equity investors, we saw that really big. It was like a 2-3 times NAV premium in 2024. I wonder how likely we are to see the NAV premium expand too much more than where it is, because when they outlined their plan, part of what they did say is that they can sell Bitcoin to fund the dividends. So now it kind of puts a little bit of a cap on the NAV premium, because why would I, as a common equity investor, pay a huge multiple on something that could potentially sell the underlying asset, right?
Yeah.
Yeah, I think we got to wait and see. We got to see that reflexivity dynamic, bring George Soros and a reflexivity back into the market and see how the treasury company dynamics fold with MNAV premiums, buying more Bitcoin, pushing price up, pushing more premiums up, pushing more Bitcoin prices up, et cetera, et cetera. And that's something that, yeah, we're just going to have to wait and see. And yeah, so with that, I think we got a couple more minutes just to wrap things up. I want to open it up to the round table here. So Val, what we do is we just quickly share what's top of mind. What are we thinking about in the next week ahead? So, it doesn't have to be a week. It could be a little bit further, a month or two. But yeah, we just want to kind of share with the audience what's top of mind. We'll save yours for a little bit later, because since you're the honorary guest, we want to give the regulars to go first since they come prepared. So, Mark, I'm gonna have you go first and share your week ahead.
Yeah, so number one for me is watching what the Senate does with the Clarity Act coming out of the July 4th recess. So any developments or movement towards a vote on that, we are coming up on the August recess window to get that done. And then other than that, watching ETF flows to see how they react out of Bitcoin coming under 60,000.
Perfect, Tomas.
You nailed it. I was going to say the exact same thing. There was the minutes, the Fed FOMC minutes coming out next week as well. I think it'd be kind of interesting, but not probably not market moving. Just interesting to understand, like if there's any tea leaves or things to read into about how Kevin Walsh is just managing things going forward. But outside of that, it's flows, ETF flows, and clarity for me.
That's very quick. Christian, over to you.
Yeah, I mean, I think for me, main focus remains macro. Let's see how markets digest the latest US labor market data. I guess we'll shape expectations for the Fed path, and by extension to global risk appetites. Yeah, I think overall, as I said, I think I concur. Clarity is a major thing to watch, but we're at a point where macro continues to set the direction. Particularly interested to see how the Korean stock market performs, and see if there's that negative relationship with Bitcoin as the bubble starts to deflate. At least see that those flows translate into flows into the crypto market.
Awesome, thank you, Val. Why don't you close us out, and then I'll wrap things up.
Yeah, absolutely. I think for me, the attention is a little bit more narrowly focused towards IPOs and upcoming IPOs. We launched xStocks IPOs a couple weeks ago with SpaceX. Just did another one yesterday with Bending Spoons. Looks like we have SK Hynix coming up next week, Friday. And so that one's coming up really quickly. SK Hynix specifically is going to be an interesting one because it's actually what's called an ADR that's being offered in the US. So the company's already public on the South Korean exchange, but it's available for the first time here in the U.S. and they're doing it via new issuance, so it's a lot like an IPO. It's also good. We'll be able to IPO that one to our xStocks clients, and that'll give me a good sense of how the market is looking at AI companies currently in the grander sense, and so that for us is going to be an exciting one.
Awesome. Yeah, definitely. For the audience, be sure to stay tuned with everything that's going on with xStocks. They're just building and shipping so fast, and there's all these dynamics that they are, basically in the center of, really, with markets. You have the AI trades, the DRAM, dynamics. That's all, an equity story. So they're in the middle of that. One quick thing for my week ahead is what Tomas was talking about with the Fed minutes. I mean, we had a unanimous hold last time, but if I could be a fly on the wall of that meeting, you have a new Fed chair, Kevin Warsh, with the old Fed chair in the same room. What are some of these awkward shadow chair dynamics that we really aren't privy to? How is that impacting the group think of the committee? I want to look at the wording. I want to know if we're seeing several participants worried about inflation versus many. I want to see kind of like these little nuanced takes in the minutes and the words that's being printed. I wish we could get more details, but I'm sure it'll be interesting if he cuts down the minutes even as well, or how they handle that as they also cut down the statement and in the June meeting. So yeah, that's what we're looking at, everyone, for next week. Be sure to tune in. We're going to be doing this again on Thursday. I want to thank everyone for participating. Val, I hopefully did not get you in trouble with compliance, but I wanted to give the audience also the questions that they want to know answered. So everyone, trade safe, always do your own research, and until next time, we'll see you.